Let us start with the new chapter. The new chapter that we are going to start is portfolio management. Let us see first of all that what are the learning points that we have say in this chapter. To explain that, so I am taking certain examples. We understand as far as the investment is concerned, investment is made by the investor so as to earn a return on the investment that say investor is making. As far as the investment is concerned, there are basically two types of investment. One is the investment where there is no risk. Examples of them are investment in any central government security, investment in any state government security. We can say that in India, investment in State Bank of India, investment in Reserve Bank of India bond, and so other, like the number of investment opportunities are there in India which have no risk. It means that say whatever the return that say they have committed, you will be able to get exactly the same return, whatever may be like the situation in the market, whether dollar rate is going up, going down, Sensex is going up, going down, there is a change in the government, whatever may be the situation, you will be able to get the return which has been committed by these organizations. Of course, friends, when you do not have the risk, then in that case, the return potential is very less. Return is practically very less over here. May it be India or anywhere in the world. So this rule is going to be applicable everywhere. That say if at all you make investment in the government securities, then in that case you'll be getting very marginal rate of return. Further, as far as the inflation is concerned, the inflation is like eroding the purchasing power of the funds, and because of that, whatever the amount that you invest today, it will have the less purchasing power when you receive the maturity amount of the deposit. If at all you are paying tax, then in that case definitely say the return that you are getting is negative in terms of the real rate of return. So you have to make investment where risk is there, and for that say different investment opportunities are there. We can say that say the investment opportunities are equity instruments, then you can make investment in like the property, real estate, you can do a business. All these investment opportunities are there where there is an element of the risk, and of course with that so the higher return is associated. In our chapter of the portfolio management, basically we are going to have a discussion regarding investment in equity instrument. We are going to have the discussion about the investment that is about the securities, and that is equity investment. We always understand that instead of making investment in one security, we should make investment in bunch of the securities. That is, we should make investment in many securities, so that say we will be able to have the diversification of the investment. In this chapter of the portfolio management, we are going to have understanding of all these things that we understand usually. In addition to that, very importantly friends, what happens at say, for example, you are studying the chapter of capital budgeting. Then in that case, say you have a simple fundamental that say you are required to make investment, or you are required to select the projects which have highest net present value. That is a simple like the investment proposal that you are going to select. But over here, when it comes to making investment in a security, then in that case there are two important aspects that we have. One is the return, and importantly, so there is a risk associated with the return. So we are supposed to consider also the risk, and based on that, say we are supposed to make investment. This is what say we are going to have understanding, say in this like very important chapter. From examination point of view, say it has been given importance by the institute, and like on an average, say more than 15 marks is say asked from this chapter in examination. This is what we have. You do not have to write anything, just I am telling that say what we are going to learn. At your intermediate level or the IPCC level, you might recall that say you have studied cash management. In that say you study something like called Baumol's model. Then you study something like Miller-Orr model. Exactly the similarly you are going to have understanding over here in portfolio management. These kind of theories that say you are going to learn. In that you are going to learn Markowitz model. You are going to learn CAPM. CAPM stands for Capital Asset Pricing Model. That is what you are going to learn. Then you are going to learn like constant mix theory, CPPI theory, like that say certain theories you are going to learn. Arbitrage pricing theory of the portfolio management. So in this chapter of the portfolio management, say we are going to have understanding that say how we should be making investment in the different securities or in combination of the securities. How we can make the prediction of the return that say we are going to have say when you make investment in a security. We are going to understand that say how to measure risk, because one of the word to which we come across over here is the risk. So how to measure that risk, that is what we are going to understand over here. So this chapter is say basically having a kind of like understanding in which we are going to like learn that say how to evaluate the different investment opportunities, how we should make investment of the funds in different securities. That is what say we are going to have the learning over here say in this chapter. Initially friends, we are going to have learning say about how to make the calculation of return, how to make the calculation of the risk. In order to make the calculation of the risk, we are going to understand say certain statistical methods. Like you might have studied in your 12th standard, variance, standard deviation, then beta, something like this that we are going to understand for the purpose of measurement of risk. This is what say we have say the overall learning aspects in this chapter. Heading right down, portfolio management. In that write down learning points. In that first one write down for an investor, broadly two types of investment opportunity is available. A, no risk. B, investment with a risk. Second point, investments having no risk will have a marginal return, full stop. Many a times it does not cover even inflation, full stop. Third point, investment opportunity with risk will surely offer more return, full stop. In that further write down, in this chapter we are going to study that how to make investment of the funds. Full stop. At the time of investment, comma, always risk and return both of them will have to be considered. Full stop. Next point, we are going to learn A, Markowitz model, B, CAPM, capital asset pricing model, C, APT, arbitrage pricing theory, D, constant mix plan, E, constant ratio plan, F, CPPI, constant portfolio proportion investment, with paragraph written and such other theories. Only having a discussion first of all, you do not have to write anything. Mr. X had purchased a security for a price of rupees 200 at the beginning of the year. At the end of the year, price of the security is found to be rupees 210. Investor received a dividend of rupees 15. Calculate a return to the investor. Can you please write answer for this question in the chat box? So friends, over here we understand that the return is required to be calculated. Return can be calculated either in rupees term or it can be calculated in percentage term. Generally we will calculate in the percentage term. Calculating the rupees term is also acceptable unless there is any clarification that you have to make the calculation in percentage term. So over here we understand that the 15 rupees is dividend income plus 210 minus 200. So 10 rupees is the change in the price of the security. So 15 plus 10, that comes to 25 divided by 200 into 100 for getting answer in percentage term, and that comes to 12.5 percentage. This is the way the return is supposed to be calculated. We understand friends that the return is supposed to be calculated taking into account the dividend income to the investor and also the price change of the security. In a way that's over here, we are required to compute the return broadly, taking the price change also as a part of the return only. You may not have sold the investment. However, for the purpose of calculation of return, we will take, say, both of them into account. We are not writing anything for the time being. We are having further discussion only. Let us see the next question. Mr. X had purchased a security at a price of rupees 300 at the beginning of the year. At the end of the year, price of the security is 250 rupees. Investor received a dividend of rupees 25. Calculate the return to the investor. Can you write answer for this in the chat box? So once again we understand that say investor has received a dividend of rupees 25. Price of the security is 250. At the beginning of the year it was 300. So 50 rupees is a reduction in the price and 25 rupees is a dividend. So we understand that the overall return is 25 negative on the investment of 300. So negative 25 upon 300, that comes to negative 8.33 percentage. So we understand logically the return can be positive also and the return can be negative also. If at all the reduction in the price of the security is more than the dividend income to the investor, then in that case, so the return would be negative. This is a way, so the return for the investment is supposed to be calculated taking into account so the dividend income to the investor and also the price change. As I told you friends, that we are going to have more focus on the equity instrument over here. That is the reason we are not discussing much about the debenture investment. As far as the debenture investment is concerned or preferential dividend, that is preferential capital investment is concerned, it is more discussed when we are doing our chapter of security analysis and security valuation, not for the time being. So this is the way, say we make the computation of the return, say for the security. Yeah, before we write answer for both of them, some further discussion. Great player Cheteshwar Pujara has scored recently as under. The previous 3 matches in which he has played, his score is given to us 100 runs, 150 runs and 110 runs. What is expected score from him in his next match? Can you write answer for this in the chat box? So friends, we understand over here that it is very simple to compute the expected score. See, basically we know that the cricket is absolutely unpredictable. You never know that say a player who does not play well in the recent matches might score good in the next match, and the reverse, it may happen that that is a player say who does great in the recent matches may not be able to score in his next match. However, generally we can say that whatever the average of this is expected score from him in his next match, so 100 plus 150 plus 110 divided by 3, so it comes to 120 runs. So 120 runs is what we understand is the score of, that is expected score of Cheteshwar Pujara in his next match. That is what we understand. Next question we are discussing before we write answers. Great player Cheteshwar Pujara is likely to score as under. Probabilities are given for say the different score that say he is likely to make. What is expected score from him? That is a question. Please write your answer in the chat box. So we understand that so this time the probability distribution information is given to us. There are 30% chances that he will score 110 runs. There are 20% chances that he will score 28 runs. There are 50% chances that he will score 180 runs. So 33 plus 28 plus 90, so it is 151 runs. So we understand that so the expected score of Cheteshwar Pujara in his next match is 151 runs. This is what we understand. Now, what kind of difference that we have in these two data? Let us have a small discussion about it. Dear students, what happens that's over here? This is like we understand is taking into account the past, we are predicting the future. So we can say something like this, that for example, Cheteshwar Pujara has recently played 3 matches, let us say in India, let us say that say against Zimbabwe, and the 4th match is also once again in India and it is against Zimbabwe. So whatever the recent score can be taken as a base say for predicting that say what will be his score in his next match. Suppose instead of this the recently it is like this, and the 4th match, or we can say that so the next match that he is going to play is, let us say, in Australia and it is against Australia, then in that case say taking this past as a base for predicting future is not possible. Why? Because say the recent matches was say in a playing condition that was different than the playing condition in Australia. Recently you played say against a team say which is not so competitive as the next team is. Then in that case going like this is like reasonably not correct. In that case you should take help of the probability distribution method. In different situations say you just make a prediction that say what will be the score of say Cheteshwar Pujara, and based on that say you have a kind of expected score. This is what's the difference that we have say in this two data. So friends, we understand over here that we can have the prediction about the future score of a player either taking the past into account, considering that say we are expecting the past to repeat in future, or otherwise we may have the probability distribution method for the purpose of estimating the future performance or the expected performance of a player. This is what we understand. Even going further, just for discussion, Mrs. Johnson Incorporation has following dividend per share and market price per share for the period 2018 to 2021. During this time period, so the dividend is provided to us, the market price is provided to us. Calculate average of annual return. Average is required to be found for annual return of Messrs. Johnson and Corporation for last 4 years. 1, 2, 3, 4. Also calculate riskiness of the investment of Messrs. Johnson and Corporation. Market price of the security of 2017 was 1100. Like that information is given. Just go through the question, then we are discussing how to do it. So friends, over here we can say something like this, that here you don't have to write anything. Let me explain you first of all. 2018, 2019, 2020 and 2021. We can make the calculation of the return like this. The dividend per share is 10 for the year 2018. Then price has increased to 1200 from 1100. Divided by 1100 into 100 for getting answer in percentage. So the answer is 10%. That is return of 2018. In 2019 it is dividend is 130 plus 1250 minus 1200 divided by 1200 into 100 again to find answer in percentage term. So the answer comes to 15%. In 2020 it is 225 plus 1400 minus 1250 divided by 1250 into 100 once again to get answer in percentage term. So in that case the answer is 30%, and for the last year it is 10% negative. So dear students, over here the first question is you are required to compute the average of this. So 10 plus 15 plus 30 minus 10, that comes to 45%. How many observations are there? 4. So divided by 4, that comes to 11.25%. This is the way we can make the computation of the return on average basis, say for these 4 years. Okay. Now, what do we understand with this? Let us have a discussion about it. So friends, we understand that, say, taking into account the previous 4 years performance of the security, we have made a calculation of the mean return, that is X bar, as 11.25%. Now, basically, we have this kind of calculation for the purpose of estimating that what will be the future return of the security. And the future return of the security is expected to be 11.25%. It means that, say, today if at all I buy the security and I hold it for 1 year, then in that case I would be able to get a return of 11.25%. That is what's the conclusion that, say, we have over here. And this is what, say, we understand is the way you can make a prediction of return from a security taking into account the past records, if at all you have a strong reason to believe that whatever the recent performance of the security is likely to be the future performance of the security. If at all that is, say, you believe that the management is going to remain same, if you believe that, say, the product mix is going to remain same, the working conditions is going to remain same, then in that case fairly we can say that, say, a kind of average of the recent year's performance is, say, the expected future performance. This is the way, say, we make the prediction of the return from any of the security or a portfolio that we are going to understand. Dear students, we understand that, say, whenever it comes to some decision making, whether it is a decision making with respect to the capital budgeting or it is a decision making with respect to the portfolio management. One very important aspect which is there in the decision making is say the estimation that you have to make, is the estimation that you have to make. So you have to make a prediction that say what is going to happen. So one of the way to predict the future return is the mean return. That is the mean return of the past returns is expected future return. This is what we understand is the expected rate of return calculation. So friends, now we are understanding further, because over here the question does not come to an end. The question says that you are required to measure the riskiness of the investment. It means that you are required to measure the volatility of the securities return. How to measure the volatility of the securities return? Let us have understanding of the same. One of the way by which you can measure the volatility is say application of the concept of standard deviation. There is a concept called normal probability distribution method. It says something like this. Whatever the result that say you have in terms of x bar, or it is also given a name as mu, has 50% probability. It means that say there are 50% chances that the return will be 11.25 percentage. It means that say there are 50% chances that the return will be greater than 11.25 percentage, and there are again 50% chances that the return will be less than 11.25 percentage. This return is likely to be different than the expected return that you have. Now, what kind of difference that it will have, what kind of deviation of the actual return that we can have from the mean return is measured in form of standard deviation. It is measured in form of volatility of the securities return. So we understand it is like this. Standard deviation is indicating that what would be the volatility of the actual return from the mean return, and it is measured by way of standard deviation. Standard deviation is indicating that say what will be the volatility of the actual return say from the mean return. That is what say the standard deviation is indicating. How to make the calculation of that volatility, that we are going to discuss say in the coming part. That is say the when we do that question. Presently my focus of this all discussion only is to explain you then how to make the prediction of the return for any of the security based on the past performance. Now dear students, there is an element of the subjectivity when we are taking the past returns into account, that whether to take returns of last 4 years, return of last 5 years, 10 years. Like if at all you see that the company like Infosys, it has been last 30 years that it is in operation. Now taking 30 years data for predicting the next year return is foolishness, because whatever the condition that the Infosys was having say before 20 years is definitely not the condition of the next year. Whatever the economic situation which was there before 20 years, that cannot be taken for the next year. So taking like some number of years of the past, we should make the prediction of the future return. So there is an element of the subjectivity which is involved over there. One more discussion of the question before we write a note, and then we will do one by one all these questions. So first of all, that is again a small discussion before we proceed further, because I want to dictate a complete good note to you so with respect to the return, and then I want to do all these questions. Current market price of the share is 170, that is P0. Dividend per share and market price per share of the security under various political situations are likely to be as under. There are 25% chances that dividend will be 7 rupees per share, 75% chances it will be 14 rupees per share, and in both the cases what would be the market price of the share is also given to us. You are required to calculate the following: expected return from the investment measured in percentage term. Calculate risk of the investment measured in percentage term. I want you to tell me answer of the first question in the chat box. Now friends, we understand over here that say there are 25% chances that the dividend income will be 7, price of the security will be 180 from 170. Divide by 170 into 100. So kindly use your calculator. 7 plus 10 divided by 170 into 100. So it comes to 10 percentage. And 75% chances that dividend will be 14 plus 190 minus 170. So the price increases by 24. Okay. Sorry, price increases by 20. So from 170 to 180 or from 170 to 190. That is what we understand. Divided by 170 into 100. So it will be 20 plus 14, that is 34 upon 170 into 100. That comes to 20 percentage. I am assigning x variable to it. Probability into x. There are 25% chances that the return is 10 percentage, that is 2.5. 75% chances the return is 20 percentage, that is 15. Okay. 25% chances of 10 and 75% chances of 20. So the weighted average return is going to be 17.5 percentage. That is x bar. This is the way we can make the computation of the expected return. Sometimes students are having a point that, sir, can we do it with the expected price and expected dividend? The answer is yes. Remember that only 1 year data is provided to us. So 25% chances dividend is 7 and 75% chances dividend is 14. So 0.25 into 7, that is 1 rupee 75 paise. 14 into 0.75, that comes to 10 rupee 50 paise. So the weighted average is 12 rupee 25 paise. Next, 180 and 190. So 25% chances that the price will be 180, that is 45, and 75% chances that it will be 190, so it is 142.5. So the answer is 187.5, friends. So based on this, the return can be calculated like this. Expected dividend 12 rupee 25 paise plus expected market price of the share 187.5. Current price is 170 whole upon 170. So 187.5 minus 170 plus 12.25 divided by 170. You get again the answer of 17.5 percentage. So either of the way you can make the computation of the expected return. That's very simple. However, the second part of the question, as far as the risk is concerned, risk can be calculated only with this information and not with this information, because we are required to find the risk for the return that we are going to generate. So for that, say we are supposed to make the calculation of the variance. Then under root of the variance is the standard deviation. That is the way we are supposed to make the computation of the standard deviation, that is the risk of the investment. Write down heading return. In that, write down first point, return for an equity investment, comma, for a period will be calculated using dividend income and change in price of security. Second point, return can be computed for any time period, comma, it can be positive or negative. Full stop. If price reduction is more than dividend income, then return will be negative. Full stop. Third formula, RT, return for the time period, is equal to D1 plus P1 minus P0 divided by P0 into 100. RT stands for return for time period. D1 stands for dividend per share. At the end of period, P0 stands for price of security at the beginning of period. P1 is price of security at the end of period. Fourth, very importantly, for decision making, in portfolio management, it is very necessary that we make a prediction of future return from investment. Full stop. It can be using past information, expected future performance. Fifth, past can be taken for predicting future if most of the important elements remain same, namely management, comma, product mix, and such other things. Full stop. With paragraph right down. In this situation, we can use average of past returns to predict future returns. Full stop. Return formula x bar is equal to summation x upon n. The term x bar stands for expected return slash mean return. N is the number of years or number of observations. And summation x is so the total of the returns. With paragraph read down, how many number of observations to be taken is to be decided subjectively. Full stop. Next point. It may happen that most of the important things have changed. Like management, comma, product mix, export ban, and such other aspects. Full stop. In that situation, taking past as a base for predicting future will be wrong. Full stop. In that case, prediction for future return for different probability is required to be made. Full stop. With that, estimated return can be calculated. Full stop. Return formula: x bar is equal to probability into x and its summation. That is the way we can have the expected rate of return to be found. Now, before I dictate the note to you for the standard deviation risk, we are doing few numericals. So let us start with the numerical. Mr. X purchased a security for a price of rupees 200 at the beginning of the period, that is P0. At the end of the year, price is 210. Investor received a dividend of rupees 15. Calculate the return to the investor. So please write an answer. Return is equal to D1 plus P1 minus P0 divided by P0 into 100. This is the way the return is found. So the dividend is an amount of rupees 15. P1 is 210. P0 is 200 whole divided by 200 into 100 for getting answer in percentage. So the answer is 12.5 percentage. Technically, friends, is 15 upon 200. 7.5% is called dividend yield, and 10 divided by 200, 5% is considered to be the capital gain yield. That is the way we can have the bifurcation for this.